when some wag said it's feasible to think responsibly about one thing and not the other. Well, I could see from that one sentence that that was perfectly ridiculous, and it pushed me further into my natural drift, which was into learning all the big ideas and all the big disciplines.
Welcome to the Deep Dive. Have you ever wondered what truly makes a business tick? Or, how governments manage those huge budgets to keep society running?
It's a massive question.
Absolutely.
Yeah.
Today, we're doing a deep dive into, well, the absolute backbone of commerce and public life, accounting and finance.
The language in the toolkit, essentially.
Exactly. At their core, these fields give us a common language for measuring performance and a really powerful toolkit for making critical decisions.
Yeah.
And what's fascinating is how these ideas aren't exactly new. They've evolved over centuries from, well, pretty surprising origins in medieval Italy all the way to the complex global standards we use today.
Right. And our mission today really is to equip you with an intuitive grasp of the big ideas, the concepts that shape financial decision-making for, well, every kind of organization.
From a tiny startup to City Hall.
Exactly. We want to cut through the jargon, get straight to the core insights, give you a quick but, thorough understanding of these essential concepts. The language of business.
Right.
Accounting fundamentals.
Okay, let's start with something truly foundational. I mean, arguably revolutionary that underpins pretty much everything else in business.
You're probably talking about double entry bookkeeping.
That's the one.
Yeah, it's at the heart of accounting. You could even argue it's the bedrock of modern capitalism. It's this elegant self-balancing system.
Self-balancing? How so?
Well, every single transaction hits at least two accounts simultaneously. It ensures that fundamental accounting equation assets, liabilities plus equity always stays perfectly in balance. Always.
It sounds incredibly elegant, and the history is just captivating. You trace it back to the Italian Renaissance.
Luca Pacioli.
Right, Luca Pacioli, that 15th century friar and mathematician. There's even that famous painting associated with him, his book in 1494, that basically set the stage for modern accounting.
It really did.
It just makes you wonder, how did businesses even manage before that? It must have been chaos, like trying to build a skyscraper without any blueprints.
Well, it was certainly less rigorous. The brilliance of double entry isn't just balancing numbers, though. It's about building a robust, sort of self-checking system.
Okay.
By tracking where money comes from and where it goes, it inherently minimizes errors. And it creates this single, sort of verifiable truth about a company's financial state.
That was revolutionary back then.
Absolutely. Still is, really. Take an example. A company borrows $10,000. Okay, so it increases its cash asset by 10 grand.
Got it. More cash.
But simultaneously, it credits or increases its loan payable liability by the same $10,000. See, it captures both sides. The benefit, the cash, and the obligation, the loan, keeps that equation balanced.
It's logical. Werner Sombart, the historian, he even argued this system was a driving force behind capitalism itself.
It's a strong argument, and its use goes way beyond just private businesses. Governments, nonprofits, they all use adaptations of double entry.
For accountability.
Exactly. Recording inflows, outflows, keeping track of different funds, all in a balanced, accountable way.
Yeah. Okay, so if double entry is the core grammar, then financial statements must be the sentences and paragraphs telling the story.
That's a perfect analogy, yeah. There are three main statements, and each gives you a really different critical perspective.
All right, what are they?
First, the balance sheet. Think of it as a snapshot. Financial position at one single point in time.
Like a photo.
Exactly. Lists assets, liabilities, equity. It physically shows you that assets, liabilities, plus equity equation.
Okay, snapshot, what's next?
Then there's the income statement, often called the P&L, profit and loss. This one reports performance over a period like a quarter or a year.
So not a snapshot, more like a movie clip.
Kind of, yeah. It summarizes revenues, expenses, and the result. Profit or loss. It answers that big question. Did the company actually make money during this time?
Crucial question. And the third?
The cash flow statement. This one shows exactly how cash moved, where it came from, where it went during that same period.
Ah, so focus purely on cash.
Right. It breaks movements down into operating, investing, and financing activities. And what's really important here is it translates that accrual accounting data, which we'll get to, back into actual cash terms, shows you the company's liquidity, how well it generates and manages cold, hard cash.
Which can be really different from reported profit.
Oh,
Right?
absolutely. Very different sometimes.
So these three statements, they're like the vital signs for a business. Each tells you something different but critical. Balance sheet shows strength, debt levels, income statement, profitability over time, cash flow.
Mm-hmm.
Is it actually generating cash?
Exactly. Put them together and you get a pretty comprehensive picture. Think about a fast-growing company.
Okay.
Income statement might show little profit, maybe even a loss, because it's pouring money into new equipment, right? Heavy investment. But the cash flow statement would show those big investment outflows and maybe big inflows from financing, like taking out loans or issuing stock.
And those loans or stock issues would then show up on the balance sheet, changing the debt and equity.
Precisely. See how they connect. They're usually prepared quarterly and annually, following standard formats, so investors, lenders, managers, everyone can compare apples to apples.
You know, we talk a lot about corporations, but how does this play out for, say, a city government? Do they issue the same kinds of reports? What's a key difference?
That's a great question. Governments absolutely produce financial statements too. They might focus more on budgetary results, though. You'll often see a statement of operations instead of an income statement, or track fund balance instead of equity.
Fund balance, okay.
But the underlying principle, still transparency, still accountability, showing citizens how their money is being managed. It's the same big idea.
But the way you account for things, the timing, that can paint really different pictures, can it? Which brings us to cash versus accrual accounting.
Huge difference. Yeah. Cash accounting is super intuitive, right? Record revenue when cash comes in, record expenses when cash goes out. Simple.
You see, straightforward.
It is, but accrual accounting generally gives a truer economic picture. Think about a magazine publisher. Okay.
They sell a $120 annual subscription in January. Cash accounting says, great, $120 revenue in January.
Instant profit boost.
But under accrual, no, they haven't earned it all yet. They recognize only $10 of revenue each month as they actually deliver the magazine and earn that money.
Ah, so it smooths it out, matches the revenue to when the service is provided.
Exactly. It's about recognizing revenues when earned and expenses when incurred. Whenever the cash actually moves, doesn't matter as much for the timing of recognition.
That magazine example really clicks. It stops companies from, playing games by prepaying expenses or collecting cash early just to make one period look amazing.
Precisely. It leads to the matching principle, which is central to accrual. You match the expenses to the revenues they help generate in the same period.
Makes sense. And that's why accrual accounting is required under the main standards like GAAP and IFRS. It just reflects economic reality better. It captures things like accounts receivable money owed to you or accounts payable money you owe things. Cash accounting ignores until the cash moves. It gives a fuller, fairer view.
So who uses which in the real world then? Is it just big companies using accrual?
Generally, yes. Most larger, especially publicly traded companies must use accrual, but cash basis, it's much simpler. So small businesses, sometimes nonprofits, might use it for their internal bookkeeping. Easier to track cash flow day to day.
And governments.
Governments are interesting. They often use cash or a modified cash basis for their annual budgets, helps control spending against actual cash limits.
Sure.
But their formal year-end financial reports, those are typically accrual-based to give that comprehensive, transparent picture to the public and bond markets.
Right. Okay. So the businesses got bigger, more global. You couldn't just have everyone winging it with their own accounting methods. Chaos. That's where rules come in. Standardization.
Absolutely necessary. And that's where you get GAAP, Generally Accepted Accounting Principles, mainly in the U.S.,
GAAP. Heard of it.
and IFRS, International Financial Reporting Standards, used by much of the rest of the world.
IFRS. Okay.
These frameworks, these sets of rules, are crucial. They ensure financial reporting is consistent, comparable, and ethical. They cover things like requiring accrual accounting, specific ways to recognize revenue and expenses, what needs to be disclosed in the notes, all for transparency.
And historically, these didn't just pop up, right? There were reasons.
Yeah.
Scandal.
Big time. Modern standards really took shape in the U.S. back in the 1930s, largely as a reaction to the lead-up to the Great Depression.
The 1929 crash.
Exactly. Before that, accounting practices were incredibly loose. Companies could hide losses, inflate profits. It fueled speculative bubbles. So the crash exposed all that, leading to federal securities laws and the creation of the SEC, the Securities and Exchange Commission, to enforce standards and restore trust.
So what are some core ideas within, say, GAAP?
Well, there's the revenue recognition principle, earn it before you book it. The matching principle, match expenses to revenues. Conservatism when in doubt, err on the side of caution, don't overstate assets or income. The going concern principle, assume the business will keep operating. And full disclosure, put all the important stuff out there, often in the footnotes to the financial statements. Material information can't be hidden.
And you mentioned IFRS for the rest of the world. There seems to be a big push globally towards convergence, getting everyone on similar standards. Even the U.S. GAAP has moved closer to IFRS in many areas.
That's right. Financial markets are global now. Capital flows across borders. Having consistent accounting standards just makes everything easier, more efficient. It lets an investor in Japan understand the financials of a company in Germany or Brazil.
Builds trust on a global scale.
That's the core idea. Whether it's corporate GAAP, IFRS, or even governmental GAAP for the public sector, it's all about building trust and accountability. For investors, donors, taxpayers, citizens, creates a common ground.
Okay, so we've got the rules of the game, but who's the referee? Who makes sure everyone's actually playing by those rules? This feels like where trust really gets tested.
Absolutely, and that's the role in auditing. An audit is an independent examination of the financial statements.
Independent being the key word.
Critical word. The whole idea is trust through verification. Independent auditors, usually CPA firms, come in and check if the company's financial statements are presented fairly. Are they free from major errors? Is there any fraud?
Because as an investor, or even just an employee relying on the company, you need that assurance, right? You need to know the numbers aren't just made up.
Exactly. You want peace of mind that revenues aren't overstated, expenses aren't hidden. An independent audit provides that essential discipline. It's not just a rubber stamp, it's a crucial safeguard.
And we've seen what happens when that safeguard fails, unfortunately.
Oh, yes. Historical failures like the massive Enron collapse back in 2001.
Huge scandal.
Huge. It happened partly because misleading accounting went unchecked for too long. That scandal directly led to much stronger regulations like the Sarbanes-Oxley Act or SOX in the U.S., demanding better internal controls and more auditor independence.
Internal controls. What are those exactly?
Those are the processes within a company designed to prevent errors and fraud. Things like requiring 2 signatures on big payments, segregating duties so one person can't both approve and pay an invoice, regular reconciliations.
Okay, checks and balances inside the company.
Right. And auditors evaluate how strong those internal controls are as part of their audit. But again, the independence of the auditor is paramount. They have to be unbiased, objective, not swayed by management.
And this isn't just for big corporations, is it? This verification idea must apply elsewhere, too.
Definitely. Government agencies get audited, got to make sure public funds are used properly. Nonprofits get audited. Donors want assurance their contributions are handled responsibly.
Same principle, different stakeholders.
Exactly. The overarching idea, always, is accountability. Accounting provides the internal record. Auditing provides that essential external check, holding management accountable to everyone who has a stake in the organization. 2. The toolkit for decisions. Finance fundamentals.
Okay, so accounting gives us the language, the record of what happened. Now let's shift gears a bit. Let's talk about finance, the tools for managing resources, allocating them, creating value for the future. And this next idea, it might be the most fundamental concept in all of finance.
You're thinking time value of money.
Exactly. The idea that $1 today is not the same as $1 tomorrow.
Absolutely fundamental. It boils down to this. Money you have now is worth more than the same amount of money you get later. Why?
Because you can invest it, right? Make it grow.
Precisely. Money can earn interest, earn a return. If you get money later, you miss out on the return you could have earned in the meantime. That's the opportunity cost.
So the simple example. $1,000 today, invested at 5%. In 1 year, it's $1,050.
Easy.
So getting $1,000 a year from now, it's worth less today because you missed out on earning that $50.
Exactly. And this simple idea is the basis for so much in finance. It leads us to discount future cash flows back to find their present value, or PV. What's a future amount worth right now?
Discounting. like reducing its value.
Kind of, yeah. If you expect $10,000 in 5 years and your required rate of return or discount rate is 7%, you'd calculate its present value. It comes out to about $7,130 today.
Meaning $7,130 invested today at 7% would grow to $10,000 in 5 years.
You got it. That's the math behind it, and we use this constantly.
It feels so intuitive yet so powerful. I read somewhere even ancient texts talked about paying extra if you repaid a loan late. The concept's been around forever.
It has. It's timeless logic. In modern applications, everywhere. Capital budgeting, deciding on big projects. Valuing bonds, what's the present value of all those future interest payments and the principal. Valuing stocks, what's the present value of all the expected future dividends.
Okay, so it applies to investments. What about, say, public money? How does time value matter there?
Oh, hugely. It explains why governments generally prefer taxes now rather than later, and why funding long-term obligations like public pensions is so challenging.
Because a dollar promised for a pension 20 years from now costs much less if you set aside and invest a smaller amount today.
Precisely. If you wait, the amount needed grows exponentially. So the big takeaway, money now is not the same as money later. Finance gives us the math to make them comparable.
Okay, building on that, another core idea, risk. And how it relates to reward. The old saying, no pain, no gain, right? That seems central to finance too.
Absolutely central. The risk-return trade-off. It's simple. Investors demand a higher expected return if they're going to take on higher uncertainty, higher risk of loss.
So safer investments, lower returns. Riskier investments, potentially higher returns.
Generally, yes. Think of a spectrum. At the low-risk end, you have things like short-term government bills. Very safe, very predictable, but low returns. Then maybe long-term government bonds, a bit more risk. Then corporate bonds. Then stocks or equity, which are much more volatile. And at the far end, speculative things like venture capital or cryptocurrencies, potential for huge gains, but also huge losses.
High risk, high potential reward.
Exactly. There are theories like the capital asset pricing model, CAPM, that try to quantify this, but the basic intuition is just demanding a risk premium. You want extra compensation for sticking your neck out.
How does this play out when companies need to raise money? Like comparing a really stable utility company versus a cutting-edge, maybe volatile biotech startup.
Great example. That's stable utility with predictable cash flows. It can issue bonds, borrow money at a relatively low interest rate. Investors see it as safe.
Low risk, premium needed.
Right. But the biotech startup, its future is uncertain. Huge potential maybe, but also a high chance of failure. To attract investors for its bonds or its stock, it has to offer the prospect of much higher returns to compensate for that risk.
Makes sense. The market demands payment for taking the gamble.
And it's the same in public finance. A country with shaky finances, it has to pay higher interest rates on its government bonds. The market prices in that risk. So, prudent finance, whether corporate or public, is always about managing this balance. What return is fair for the level of risk involved?
Okay, so if risk is inherent and higher risk demands higher return, how do you manage that risk without just sticking to super safe, low return stuff? How do you handle it?
Now we get to what's often called the only free lunch in finance.
A free lunch. Sounds good.
Diversification. It's that classic wisdom. Don't put all your eggs in one basket.
Right. Spread your bets.
Exactly. By spreading your investments across different assets, different companies, different industries, different countries, even different asset types like stocks and bonds, you can reduce your overall risk without necessarily sacrificing your expected return.
How does that work practically? If I invest everything in just one tech stock, I'm totally exposed if that company tanks.
Totally exposed. High risk.
But if I invest in, say, 20 different stocks across tech, healthcare, consumer goods, energy.
Then if one company has a problem, or even one whole sector struggles, the others might do well, or at least okay. The ups and downs tend to partially cancel each other out. It smooths out the ride, reduces the overall volatility of your portfolio.
So it dampens the big swings.
Precisely. Now, it's important to understand what it can and can't do. Diversification is great at reducing unsystematic risk. That's the risk specific to one company or one asset.
Like a bad earnings report for one firm.
Yeah, but it can't eliminate systematic risk. That's the market-wide risk. Things like recessions, interest rate changes, big geopolitical events that affect almost all investments.
Okay, so it reduces company-specific risk, not overall market risk.
Right. Harry Markowitz won a Nobel Prize for work on this back in the 1950s, Modern Portfolio Theory, MPT. He showed mathematically how combining assets that don't move perfectly in sync can lower portfolio risk. Think stocks and bonds often. When one goes up, the other might go down or stay flat. Combining them give you a better risk-adjusted return.
That's why you often hear about balanced portfolios, like a 60/40 stock-bond mix.
That's a classic example, yeah. Trying to get some growth from stocks, but some stability from bonds. Reduces volatility compared to 100% stocks.
So diversification really is key.
It's fundamental. It's why mutual funds and ETFs are so popular. They offer instant diversification. And it's how large institutional investors like public pension funds manage their huge portfolios to protect retirees' savings. It's a core principle for building resilient investments.
Okay, let's get practical now. Companies have money. Maybe they raised it through debt or equity.
Yeah.
How do they decide which big projects to actually spend it on? Building a new factory, launching a new product line. How do they choose?
That's capital budgeting. It's the whole process of evaluating potential major investments, long-term projects.
What's the big idea behind it?
The core idea is simple. A project is only worth doing if it's expected to increase the company's value. Its benefits need to outweigh its costs, but importantly, after you account for the time value of money and the risk involved.
Ah, so time value and risk come back into play.
Always. And the main tool used for this is net present value analysis, or NPV.
NPV. Heard of that one too. How does it work?
You forecast all the future cash flows a project is expected to generate. Then you discount each of those future cash flows back to its present value using a discount rate that reflects the project's risk and the company's cost of capital.
Okay, bring all future benefits back to today's dollars.
Right. Then you add up all those present values and subtract the initial cost of the project. If the result, the NPV, is positive,
It means the project is expected to create more value than it costs. Thumbs up.
thumbs up. It signals invest. A positive NPV means the project should increase shareholder wealth. If it's negative, the project is expected to destroy value.
Let's use that factory example. Costs $5 million up front, generates $1 million a year for 7 years. You discount those $1 million payments back.
Right, using an appropriate discount rate.
And let's say the total present value of those inflows comes to $5.5 million.
Okay, so NPV, it equals $5.5 million, PV of inflows, $5 million initial cost, positive $0.5 million.
So the signal is go. It adds $500,000 in value.
That's the signal from NPV, yes. Now, there are other metrics companies look at, like internal rate of return, IRR, which tells you the project's percentage return, or payback period, how quickly you get your initial investment back.
But NPV is king.
Generally considered the gold standard, yeah, because it directly measures the value creation in dollar terms. It answers the fundamental question, how much wealth does this project add?
It's interesting how these formal methods, NPV, IRR, really took off mid-20th century. As businesses got bigger, needed more capital. They couldn't just rely on gut feel anymore.
Needed rigor, needed financial science to allocate scarce capital effectively.
And does this apply outside corporations? Like a city building a bridge?
Absolutely. Public sector uses similar principles, often framed as cost-benefit analysis, but the core logic is the same. Are the discounted future benefits, which might be economic activity, save time, safety, not just cash greater than the discounted costs.
Right.
Deploy capital where it yields the highest risk-adjusted return, whether that return is profit or public good.
Okay, so companies use NPV to decide which projects to fund. But where does the money for those projects come from? How do they decide the mix? Borrow money or sell more ownership shares? Debt versus equity.
Right, that's the capital structure decision. What's the optimal mix of debt and equity financing?
Optimal meaning.
Meaning the mix that minimizes the company's overall cost of capital, getting funds as cheaply as possible, basically.
And the options are debt loans, bonds and equity, selling shares, ownership.
Exactly. Debt means you owe fixed payments, interest, and principal. Equity means owners share in the profits, but also the risks. Debt holders get paid before equity holders if things go bad.
Now, here's something that seems counterintuitive again. You often hear that debt is cheaper than equity. Why would borrowing be cheaper than just getting money from owners?
Yeah, it seems odd at first. Two main reasons. First, in many countries, the interest payments on debt are tax deductible.
Ah, the tax shield.
Exactly. That effectively lowers the cost of debt financing because the government is kind of subsidizing it through lower taxes. Equity dividends are usually paid out of after-tax profits, no deduction.
Okay, tax advantage. What's the second reason?
Debt holders generally take less risk than equity holders. They have a prior claim on assets if the company struggles. Less risk means they demand a lower rate of return compared to equity investors, who bear the brunt of the downside risk, but also get all the upside potential.
So debt seems great. Cheaper tax break? Why not load up on debt?
Ah, the catch. There's a hidden cost to too much debt. As you pile on more debt, the company becomes riskier. The chance of financial distress, not being able to make payments, or even bankruptcy goes way up.
And bankruptcy is expensive. Legal fees, disruption.
Hugely expensive. Plus, just the risk of distress can hurt. Customers might leave, suppliers might demand cash up front, talented employees might jump ship. These are real costs.
So there's a trade-off.
Exactly. The trade-off theory of capital structure says companies balance the tax advantages of debt against these rising costs of financial distress. Initially, adding some debt lowers the overall cost of capital, but beyond a certain point, the bankruptcy risk gets too high and the cost of capital starts increasing again.
So there's a sweet spot.
There's believed to be an optimal range, yeah. It's actually fascinating. Some early finance theory, the Modigliani-Miller theorems, showed that in a perfect world without taxes or bankruptcy costs, capital structure wouldn't matter.
Really?
Yeah, but their work was crucial because it highlighted why it matters in the real world precisely because we have taxes and bankruptcy costs.
Got it. So the practical goal is find that target debt-to-equity ratio that hits the low point for the weighted average cost of capital, the WACC.
That's the idea. WACC is the blended average cost of all your financing, debt, and equity, weighted by how much of each you use. Minimizing WACC maximizes the firm's value.
And does this look different for different types of companies?
Oh, definitely. Stable businesses, like utilities with predictable cash flows, they can safely handle more debt, take more advantage of that tax shield.
Lower risk of distress.
Right. But volatile businesses, like tech startups, much riskier cash flows. They tend to rely more heavily on equity, even though it's technically more expensive, because taking on lots of debt would be too dangerous in a downturn.
And governments. They issue bonds, which is debt. Do they think about this balance?
They certainly do. Governments manage their debt levels very carefully, things like municipal bonds. Too much debt leads to higher interest costs, potential downgrades in their credit rating, which makes future borrowing even more expensive. It's a similar balancing act, managing the need for public investment against the burden of future debt payments.
So again, it's about finding that balance, supporting operations and investment at the lowest reasonable cost and risk. Okay, last piece of the finance puzzle for today. Where does all this buying and selling of stocks, bonds, the setting of interest rates, where does it happen? Financial markets was the big idea there. Does it affect how businesses operate?
Hugely. Financial markets are the arenas, the platforms where securities are issued and traded, where companies raise capital, where investors allocate savings, and where prices are set by supply and demand.
And information plays a key role.
Right. Absolutely critical. This leads to a foundational, though sometimes controversial, idea. The efficient market hypothesis, or EMH.
Efficient markets. What does that mean, efficient?
In simple terms, it means that financial markets are very good, very efficient at processing information. Asset prices, stock prices, bond prices are believed to reflect all available information almost instantly.
All available information. Wow. So if good news comes out about a company,
The price adjusts upwards immediately. Bad news. Price drops immediately. The implication is stark. It's extremely difficult, maybe impossible, to consistently beat the market by finding undervalued stocks or timing the market perfectly.
because any information you have is probably already reflected in the price.
That's the core idea of the semi-strong form of EMH, which is the most commonly discussed. Public information gets priced in very, very quickly.
So for the average investor, trying to actively trade and pick winners is a tough game. Maybe just buying a broad market index fund is better.
EMH would certainly lean that way, yeah. Passive investing makes a lot of sense if markets are highly efficient. Why pay fees for active management if it's so hard to outperform consistently?
Makes sense. But is EMH totally true? Do markets never get it wrong? What about bubbles, crashes?
Great point. EMH has a lot of empirical support, but it's not perfect. We definitely see market anomalies, things like momentum, where stocks that have gone up keep going up for a while, and bubbles where prices seem detached from fundamentals.
Like the dot-com bubble.
Exactly. And the field of behavioral finance has shown how human psychology, overconfidence, herd behavior, fear, greed can lead to irrational decisions and temporary mispricings. So the reality is probably that markets are mostly efficient, but not perfectly efficient.
So understanding both the efficiency and the potential for irrationality is key. How does this affect businesses making decisions?
Well, market efficiency influences how their stock is valued, which impacts their ability to raise capital, use stock for acquisitions, etc. If the market is efficient, their stock price is seen as a fair reflection of their prospects.
And in public finance, does efficiency matter for government bonds?
Oh, yes. Efficient government bond markets mean that the yields, the interest rates on those bonds, should reflect all the known information about the country's fiscal health, its economic outlook, its political stability. It determines the government's cost of borrowing.
So markets are powerful information processors, but maybe not flawless ones. 3, principles across sectors, public and nonprofit finance. Okay, we spent a lot of time on the corporate world, but these big ideas, accounting for transparency, finance for decision-making, do they still hold up when we look at governments or nonprofits, or is it a totally different ballgame?
The core principles definitely still apply, but the objectives and some of the mechanics are different. Let's take public finance first, governments. Their central goals aren't profit. They're about providing public goods and services, roads, schools, defense, managing the economy, redistributing income through taxes and benefits. So the focus is on budgeting, allocating resources effectively, managing public debt.
We touched on their accounting, accrual for reports, often cash for budgets.
Right. The annual budget is often the primary control document, focused on keeping spending within authorized limits, managing deficits. Accountability to taxpayers is paramount.
And government debt, you hear about it all the time. How is it similar or different to corporate debt?
Similar in that it's borrowing against future resources. Governments borrow, often massively, to fund big infrastructure projects, just like companies do, or sometimes to cover operating deficits or stimulate the economy.
But the scale can be immense.
Immense. And while moderate debt can be productive, excessive government debt can lead to problems. Rising interest costs, crowding out other spending, risk of default, higher taxes down the road. So metrics like the debt-to-GDP ratio become really important. It's kind of analogous to a company's debt to equity, a measure of leverage and risk.
So managing that debt burden is key for long-term stability.
Absolutely. Public finance also deals with broader issues like designing tax systems fairly and efficiently and using fiscal policy, government spending, and taxation to try and stabilize the economy during booms and busts.
Okay, that's governments. What about the nonprofit sector? Charities, foundations, NGOs. What guides their financial thinking?
Their guiding star is their mission. Financial management is about being accountable to that mission and to their donors, maximizing social impact while maintaining financial health and sustainability.
Stewardship, then.
Stewardship is the perfect word. A key feature you often see is fund accounting.
Fund counting.
Yeah, it means they segregate resources based on their purpose or donor restrictions. Money donated specifically for, say, a literacy program has to be tracked separately and used only for that program. Ensures donor intent is honored.
So if they're not aiming for profit, what does their equivalent of an income statement or equity look like? How do they measure success financially?
Good question. Instead of equity, they usually talk about net assets. And these are often classified as unrestricted, usable for any purpose, or restricted by time or purpose based on donor stipulations.
Okay, net assets.
And instead of an income statement, they typically have a statement of activities. It shows revenues, donations, grants, program fees, and expenses, and tracks the change in those net assets over the year.
So the goal isn't profit, but maybe breaking even, or a small surplus to reinvest.
Exactly. Aiming for zero or a small positive change in unrestricted net assets is often the goal, allowing them to sustain and potentially grow their programs. It's all about demonstrating responsible use of funds towards the mission.
But do core finance ideas like time value, risk management still apply?
Oh, absolutely, just in different contexts. A nonprofit with an endowment fund needs to invest it prudently, using diversification and considering risk and return to support the mission long term.
Like a university managing its endowment.
Perfect example. Or a charity deciding whether to invest in a big fundraising campaign, they'd implicitly do a cost-benefit analysis, weighing the expected donations against the cost, considering the time value of those future donations. The tools are adaptable. So really, the unifying lesson here across corporations, governments, and nonprofits is that sound financial management is the bedrock of trust and long-term sustainability.
Doesn't matter if the bottom line is profit dollars or quality public services or lives changed by a charity.
Exactly. It all relies on clear, honest record keeping. That's the accounting piece. And prudent borrowing, thoughtful investment decisions, managing risk, that's the finance piece. And underpinning it all is transparency and accountability to whoever the stakeholders are. Shareholders, taxpayers, donors, citizens. It's the invisible framework holding so much together. Outro.
So wrapping this all up, what does this deep dive mean for you? We've seen accounting acts as this consistent, truthful language. It allows us to understand and compare economic activity, whether it's a company, a city, or a charity.
Provides that common ground.
Right. And finance. That's the toolkit, guiding how we allocate those resources, how we make choices to create value, manage uncertainty, plan for the future.
The compass for decisions.
And these ideas, they weren't just invented overnight. They evolved over centuries, didn't they? Shaped by real-world events, practical needs, from Renaissance merchants needing better books to modern markets needing complex risk models.
It's a constant evolution. Theory informs practice, practice pushes theory. Think about how technology is changing things now. Fintech, AI.
Right. But what's fascinating, as you said earlier, is that even with all that change, the core principles seem timeless.
They really are. Ensuring accuracy, balancing risk and reward, understanding that trade-off between today and tomorrow time value, being accountable. Those fundamental ideas, they stick around.
And having even just an intuitive grasp of them helps make sense of the world, doesn't it? You start to see why a company's stock price jumps on good news, efficient markets pricing it in, or why a seemingly profitable business can suddenly run out of cash, the difference between accrual profit and actual cash flow.
Or why governments can't just borrow forever without consequences.
Exactly. It unlocks a different way of seeing economic behavior.
In the end, accounting and finance together give us both that measuring stick and that decision-making compass for so much of our organized activity. Learning these core ideas, even at a high level, it gives you a powerful lens.
A lens for seeing how value is created, how it's measured, how it's preserved, or sometimes lost.
Precisely. And that perspective, well, it's invaluable. Whether you're running a company, involved in public service, managing a nonprofit, or honestly, even just planning your own personal finances. Understanding these fundamentals helps you navigate the economic decisions that shape not just your own life, but really our collective well-being.